Hi, I'm Freddie Brick of Muddy Waters Capital. I'm here on Zer0es TV today with Professor Dan Taylor of Wharton. Dan, great to have you on. Thank you for joining us again.
Happy to be here. Happy to be back.
You mentioned being back, and for those of you who aren't aware, we had Dan on last year. We featured some of the excellent work he was doing to alert the SEC to problematic patterns of legal insider trading of stocks from executives at U.S. listed companies.
Form 144s are filed on paper, hand signature. If that's happening in the year 2021, that tells you that there are serious information plumbing problems and disclosure problems that have lurked below the surface. It's not GameStop, it's not ESG, it's not climate, it's basic stuff.
And I'm really pleased to say that after it was featured on Zero's, the Wall Street Journal kind of ran with the story belatedly. And it even went to the extent that the SEC actually really picked up and focused on your work. And that work is no longer living in the bowels of academia. It's actually being put into practice in real life. Tell us a little bit about how it goes from being a thought in your mind all the way through to likely to end up as law. That would be excellent.
Yeah, so I guess to do a level set and to bring everybody up to speed with what I was doing, I guess last time we were here was, a year ago. So it was maybe in the thick of COVID. There were these trading scandals about Pfizer and Moderna and these 10b5-1 plans that basically these pre-planned trades that corporate executives would make. They'd sign on a piece of paper in advance to trade on a specific date, and then the trade would execute. And the trades coincidentally always happen to be before material events or avoid losses if they were sales, or make considerable profits if they were purchases. And we did some investigation of that, and it turned out that the necessary disclosure for those plans wasn't actually being required. And so we did our sort of a forensic analysis and did this deep dive, and we found that there was this form, and followers of markets will know what this form is, maybe. This form 144. So this was our mythical form that very few people knew existed. Form 144 is interesting because Form 144 contains the date that the plan was adopted of these pre-planned trades. So you could look back at when the plan was actually adopted and correlate that with whether the executive knew any information at the time that they adopted the plan, as opposed to when the trade was executed. The other thing that's interesting about Form 144 is that corporate officers and directors of U.S. domiciled companies have to file all their trades on Form 4. That's electronic. It's on the SEC. That's all kinds of different data products follow that. Tip ranks is a popular one. But if you're a foreign domiciled company that's listed on the U.S., so DD, Alibaba, AstraZeneca, you name it. And this was, as you know, and specialized in a wave of Chinese frauds that were listed in the U.S. Their insiders did not have to file a Form 4 for their trades. So the trades of their officers and directors doesn't have to be disclosed to the SEC or to the public in the U.S., even though they're listed in the U.S. But they do have to file this Form 144 with the trades, with the sales. And so now you might be listening carefully, and this is, wait a minute, Taylor, I thought you just said that they don't have to file their trades with the SEC or with the public, but yet they have to file this Form 144. And apparently the Form 144 also has this interesting date on 10b5-1 plans. So what gives? Well, as we talked about last time, Form 144 is filed on paper. On paper. So we did our analysis, and there were over 700,000 paper Form 144s that have been filed with the SEC since the year 2002. And those forms are stored in file cabinets in the SEC reading room. And so when I tell people this story, they look at me kind of, like oddly, they'll tilt their head. They say, like, what are you talking about, man? It can't be that way. And so in two of my academic papers, we actually took a picture of the room with the file cabinets, with the forms in it, with the research assistants poring over these forms. And so that's really what I guess the first time I was on Zer0es talking about that. We had just discovered this. We had just sort of rolled it out, just written the academic paper on 10b5-1 plans, really blew up 10b5-1 plans. Based on that, we've had, surprisingly, because I'm not normally an optimist, but we've had a surprisingly good amount of impact, I would say, on practice and more importantly on the regulators. So a couple of things have happened since that time. First, the SEC has put a proposed rule in place to make that form electronically filed on Edgar. Not only was it a proposed rule, but last week it was passed as a final rule. So the SEC will no longer be accepting paper filings of any sort. Everything will have to be filed publicly on Edgar. So all 700,000 Form 144s, well, unfortunately, they're lost into the ether. But henceforth, 144s will be electronic and will be posted on Edgar. I think the implementation phase-in period is about 12 months. So that's a big deal because now all of those foreign insiders will now have to be disclosing their 144, their stock sales on Edgar. So that will expose their stock sales to public scrutiny. The second thing that changed, and this is not final yet, is the SEC proposed rule changes to these Rule 10b5-1 trading plans. And in the intervening period, I also wrote an op-ed with SEC Commissioner Caroline Crenshaw calling for the SEC to make changes to Rule 10b5-1 plans. And it was proposed on a bipartisan basis. So very few things get done in Washington on a bipartisan basis these days, and definitely very few things get done at the SEC on a bipartisan basis. So all 5 unanimous commissioners approved of the proposed rule changes to 10b5-1. So what those, just to cover what those are, is before you could adopt this plan, you write on a piece of paper, broker instructions, hey, here's a series of limit orders and prices that I want you to execute, and here are the days I want you to execute. And that's what Rule 10b5-1 did. And that allowed the insider to then escape scrutiny for the trades. So when the SEC would come knocking, the insider would whip out the 10b5-1 instructions they sent to the broker and said, nothing to see here, 10b5-1. Well, it turned out once we got the Form 144 data, we could actually get data on the adoption dates. So the adoption dates weren't mandatory disclosure on any other form. So now we have a large sample of adoption dates of over 20,000 plans. And it turned out that many insiders were putting in place the plan on Friday to execute the trade on Monday, and that would be it. It wasn't this sort of long scheduled sale over the course of years or course of months. And so it was effectively nothing more than a limit order. So if you put in a limit order on Friday at a certain price and it triggers Monday, that gives you an insider trading shield. And we didn't think that made much sense.
Interesting. I mean, I know we had spoken briefly, and I think you actually had singled out. I mean, look, we're generally focused on the bad actors, so that's where typically my mind wanders. But and it's not often they're associated with praise. But I think you said both Bezos and Mark Zuckerberg are actually examples of how 10b5 plans should actually work.
Yeah. So what they're doing is they're relatively wealthy individuals, and so they don't need to engage in insider trading, and they don't really care that much about small moves in the market. So their plans basically sell a similar amount of shares or similar dollar amount, on the same day every week or the same day every month. And it's a long run plan that occurs over multiple years. So that's what the spirit behind Rule 10b5-1 was, to take a large chunk of equity and then slowly sell it off over time. But, unfortunately, with financial engineering and everything, some creative lawyer looked at the rule and said, the rule doesn't actually require you to have more than one trade spread out over any period of time. And so there are some plans that are adopted and execute trades on the same day the plan is adopted. Basically, the plan has been interpreted very liberally as a set of broker instructions. And as you know, you can instruct your broker to do almost anything, or trigger trade based on almost any condition. And so what we had urged the SEC to do, which they did actually propose, was to put in a cooling off period between when the plan is adopted and when the first trade can occur. So what we found is that 60 days, 2 months, seem to be the magic number. On average, the trades that were executed less than 60 days after plan adoption avoided massive losses. But if you waited 60 days or longer, it seemed to work out. You weren't avoiding losses. There wasn't evidence of strategic intent on average. And so another analysis that we did is we looked at earnings front running. So we found 38% of plans are adopted in a quarter and execute a trade before that quarterly earnings announcement. That's problematic to me because executives are going to be, in possession of material non-public information on a daily basis. And so the notion that they would adopt and trade in the same quarter seemed odd. So the SEC's proposal was a 4-month cooling off period. So from the time you adopt the plan until the time that it executes, you have to wait. 4 months. They also, I didn't think this was a big deal, but apparently it is. They also proposed that executives certify that they were operating the plan in good faith. Now that doesn't seem to be that big of a deal, like to certify that the plan is operated in good faith. But if you look at the comment file, so the way this works is when the SEC proposes a rule change, it has to ask for comments from the public for 60 to 90 days. And that's when all of the lobbying kicks into high gear. Because then everybody who doesn't want to wait 4 months to trade or who doesn't want to certify the plan in good faith pays law firms to lobby the SEC and to write nasty comment letters threatening to sue the SEC. And I was surprised that one of the big pushbacks from all these law firms was, we don't think that the executive should have to certify in good faith that the plan is operated in good faith. It would expose them to undue litigation risk. I agree with that, except for the word undue.
Right. So in terms of the lobbying effort, where is that narrowly focused on that particular issue? Has it been a very aggressive lobbying effort? And do you expect this to be watered down significantly?
So that's a great question. So I think the reason that the paper filings got switched to electronic filings within probably 18 months is there's no lobbying interest in favor of paper filings. It's not like you have the paper mill calling up the SEC saying, keep the paper filing. So that went through relatively quick.
Certain Russian and Chinese executives are probably a little bit upset about that loophole, and it's not like law firms are choosy in their customers that they care as long as they get paid.
Right. Well, it's a good time in the geopolitical sphere for these changes to occur. So yeah, I would say I'm not sure what's going to happen with 10b5-1. I do know that there are well-funded money interests that have submitted comment letters saying that the SEC, should dial it back, and that it would reduce the value of 10b5-1 to executives. And I think what those comment letters miss is that that's the purpose of the rule proposal. I mean, the current rule was a license to insider trade. And so necessarily taking the get out of jail free card back will lead to, less use of Rule 10b5-1, only the opportunistic use. It's not going to change Zuckerberg or Bezos's use of these plans. It's only going to change the use of the plans for people who wanted to adopt the plan on Friday and sell on Monday. And the other thing I would point out is they always have the option to submit a market order. Like, they don't have to use a 10b5-1 plan to trade. They can trade on the open market just like you and I do. So it's ultimately a choice. So we'll see. I'm optimistic that it'll get through, but you never know how divided Washington is, and I know that if you're trying to do something, if the SEC is ever going to do anything to rein in some aspect of corporate America, it's going to get pushed back. I don't anticipate, though, and maybe this was an unintended consequence. I don't anticipate that this will be Gensler's most controversial rule. And so one of the nice things is that I think in relative comparison, the rule's not as controversial as some of the other stuff that the SEC has in its pipeline. So that's really two aspects of progress. And then, the third aspect of progress that you touched on with the Russian and Chinese insiders is we recently did analysis and wrote a paper with former SEC Commissioner Rob Jackson called Holding Foreign Insiders Accountable. And we used that 144 data to actually look at the trades of those corporate insiders at these foreign domiciled institutions listed in the US. So Didi, Baba, so on and so forth, Yandex. And what we found is just remarkable. It's striking that the trades of Chinese insiders on average occur before stock price drops of 20% or more. So on average, they sell and stock prices just crater. And we didn't find that. So you say, well, Taylor, China in general, the Golden Dragon Index, everything has gone down. No, we can do it relative to the Golden Dragon Index. We can look back in time before China imploded. And the explanation is that they are beyond the reach of U.S. justice. Like, what does a Russian insider who's domiciled in Russia or in China have to fear from the SEC or from the Department of Justice? And so consequently, they can afford to trade more aggressively. In the case of some of these Cayman shell companies we looked at, their trades on average avoided losses of 50%, right? Like, that's pretty egregious. And we looked at the distribution, so we looked at medians, and so we know it's not driven by outliers or just a few bad actors. It's concentrated bad actors in these foreign companies that are listed on U.S. exchanges. So Rob did some testimony on the paper at the Senate Banking Committee, and fortunately, Senator Kennedy from Louisiana introduced a bill very recently in the past month in May called the Holding Foreign Insiders Accountable Act.
And I do not want to get into a new Cold War. All I want, and I think all the rest of us want, is for China to play by the rules. Now, I have a bill. It's very simple. It says to all the companies out there in the world, including but not limited to China, if you want to list on an American exchange, you have to submit an audit. And the SEC has the right to look at that audit and audit the audit. And if you refuse, not once, not twice, but 3 times, if over a 3-year period, each of those 3 years, the company says you cannot audit my audit, then they can no longer be listed on the American exchanges. It's very, very simple. The name of our bill, Senator Chris Van Hollen. The name of our bill is the Holding Foreign Companies Accountable Act.
That will basically require these insiders and foreign companies to file Form 4. So we're going to level set. We're going to say the disclosure standards for U.S. companies, we are also going to apply to foreign companies that are listed in the U.S. Now, you might recognize that name, Senator Kennedy. He was also the sponsor for the Holding Foreign Companies Accountable Act that came about because the PCAOB couldn't inspect these Chinese companies. And so we're hoping that we can build on that success to basically level set disclosure requirements for insider trades across all companies listed in the U.S., regardless of whether you're foreign or domestic. So that might not stop our Russian and Chinese insiders from engaging in illicit activity, but we'll be able to scrutinize it much more, and the public will scrutinize it. And Freddie, you can use it as a trading signal if you like.
Sounds good. I mean, yeah, it's pretty mind blowing that in some of these companies the margins would be as large as 50%. 20 to 30% was probably mentally where I benchmarked it. Look, it's great from my seat that there has been so much progress. I think rightly or wrongly, regulatory agencies, they get a hard time from the investing public. People always asking, well, why are you behind the curve on this and that? And I think it's well documented that a lot of these agencies, are somewhat understaffed, and they're often, like, to a certain extent, under undue pressure to look here, there, and everywhere. And, this is being filmed in a week where, basically a Ponzi scheme like the dwarfs anything that happened to Madoff as blown up in crypto land. So again, you kind of ask like, how, where, why can the agency not kind of reach these things? But from your seat, does this kind of encourage you that regulation is heading the right way? Are there other aspects of either insider trading or market regulation that you're particularly focused on and keen to push forward, or is this going to be like a mic drop moment for Dan Taylor and regulation?
Well, so I think the secret is to focus on basic issues that are not generally considered sexy in the public domain, right? So I think, for example, if I was on here talking about climate disclosure or ESG in some vague sense, or corporate sustainable reporting, it's not clear to me that I could have an impact on those spaces because of the amount of money lobbying in those spaces and the amount of, frankly, people talking about it, whether they be experts or charlatans. Everybody's talking about it. So, like paper filings is like something that we could put a stamp on. Like who's in favor of paper filings? No one. Okay, so maybe we can fix that. Who's in favor of Russian and Chinese corporate insiders having lower disclosure standards than U.S.? Haven't heard anyone yet. Maybe somebody will come out of the woodwork. And so I think if you're looking to affect policy, I think you have to, unfortunately, bite off small chunks and then work with credible people. So, my institution, Wharton, has certainly given credibility to what I'm saying that I might not otherwise have had. Sort of the fact that I work with the commission, had an op-ed with the SEC commissioner. I think getting that credibility is very important. And I think it's, in some sense, it's somewhat hard within the private sector to do that because everyone's trying to think about what's your angle. Well, like Citadel wants this rule. Well, what's Citadel's angle behind wanting that rule? Whereas we don't really have an angle because we're academics, and like what angle do you have on paper filings? So I would say credibility is important and biting off small chunks. So am I optimistic that things will change? Yes. And maybe I'm too optimistic now. I mean, if we can get a co-sponsor on that Holding Foreign Insiders Accountable bill, make it bipartisan, there's a chance that maybe it gets through both the House and the Senate. But I think that's what people aren't talking about. What they need to talk about is that information plumbing. I mean, like, it took us a couple months of work and we found there was this paper form in this filing cabinet in the basement. Like, that can't be the only thing, right? But instead, everybody talks about these high-level issues that are in the Wall Street Journal and ESG and climate. And I think those, in some sense, distract from, serious information plumbing problems. That's because their distractions are there. It actually opens up a window for change on what's considered, lesser problem. I'm encouraged. I think the SEC will get the 10b5-1 rule change finalized. Hopefully we can get through the Senate and the House with the bill, but obviously we need retail support. If you're listening to this and you're like, that sounds great, let's give Taylor resources, do more of it. Check me out at Wharton, Wharton Forensic Analytics Lab, and we need support and we need backers. But yeah, I'm optimistic. Do I think it'll be a mic drop moment? I'd like to think not. I'd like to think I'm in my 40s, still got a couple decades left. Hopefully, still got some juice in me. What's next? I don't know. Payment for order flow, I think, will be interesting. Got doing some work on. I don't want to lead too much into this, but we're doing some work on payment for order flow. It'll be really interesting. If it turns out the way I think it turns out, it'll be another bomb drop on payment for order flow. So yeah, and again, it's information. It's digging into the data. We're doing data-based or evidence-based policy making as opposed to, political based.
Well, Dan, thank you again for coming on. Been following your work since we spoke last year. Really pleased to see that it's been taken seriously because I know the work is very serious, and I think the analysis of the data was, not only finding this reading room existed, but the analysis throughout it has been rigorous, and I think that really speaks for the quality of the work that you guys are doing and has largely probably contributed to the success of something that I think is very sexy, but probably not everyone else thinks the SEC reading room is that sexy. So thank you for the work you do, helping make markets fairer for everyone. And great to have you on the show. And we'd, depending on where you end up on the payment for order flow, maybe stay tuned, and that'll be the next Dan Taylor special.
Yeah, I think you'll like that one. But I'm happy to be on. Absolutely, thanks for having me, and especially to share the good news. It's always good to share good news and change. So thanks a lot, Freddie.